In this session, we're going to look at some of the major questions or common questions that are asked in finance interviews from, let's say, MBA finance guys, and how do we tackle them as we go along. Just a small bit of note before we start that this is not an exhaustive list of questions that can be asked in a finance interview. The idea is to basically look at covering some of the major questions and indicate the kind of questions that are asked, and probably also look at how do we go about preparing for the topics. What are the major topics that we need to cover as we go along? So that's the broader context of what is going to get discussed. Let's jump right into the kind of questions that are asked. Your most likely question is going to ask you, why do you want to do an MBA in finance? Right now, I think this is where bulk of us end up faltering right at the beginning of any kind of an interview, which is essentially, why am I so interested in finance? Now, while the main answer stays, unique to each one of us, some of the common tenets that you would want while you're building careers in finance is that you really like to look at businesses and their numbers, essentially, in terms of what kind of profitability businesses have, what kind of growth businesses have, etc., and those kind of data points. You would want to kind of look at how do businesses essentially make money, and that is again something that you would be interested in as you're saying that. So, how do businesses basically make money? How do businesses generate value? What kind of value gets generated over businesses as you kind of look at their numbers? This is something that needs to be intriguing for you when you try and build a career in finance, right? You need to know, how do businesses make money? How do the numbers stack up? How do investments work, right? And how do people plan around those investments? So essentially, the domain in terms of how does a business make money, how does a business create money, how do investments work, plans work around those investments, and the other part around how do businesses raise and deploy money, essentially. So this is again specific to businesses, that how do you raise money? These are points that should be fascinating to you, and if these are fascinating, then that is why you are basically trying to get into an MBA finance. The whole idea is that when you run a business, when you manage a business, the most important aspect that is seen from the perspective of a business owner is the financial part of it. What is the kind of profitability it is achieving? What is the kind of volumes businesses are achieving? Operationally, are the businesses making money? Cash flow wise, are the businesses making money? If that is something that interests you, that is your first answer that needs to come in, right? Uh, this needs to get reflected in the next question that typically comes to a lot of people, which is, tell me something about yourself. That's where you have to showcase your intent, right? Now, remember, this is a very simple question, but most people end up essentially answering it incorrectly. Incorrectly, not in there's no correct, right, or wrong way to answer this kind of a question. It's a subjective question, so everyone's answer would differ. But what people are essentially looking for is not too much about your personal life, or where do you come from and what's the idea around your studies and all, but what intent do you have with respect to your career? So if you do want to build a career in finance, this is the question where you lead people to essentially that kind of a decision making, specifically around why or how did you arrive at the decision of doing an MBA. So why an MBA? And within that, why finance? And probably in this, you have to showcase your interest around an MBA or finance, and your intent as to what you want to do. Maybe anything, any kind of project that you have taken up in the past, any kind of experience that you have had in the past, which results in you thinking as to why should you go around doing an MBA in finance? Why would you want to build a career in finance? People are not really interested about where did you do your schooling from or where did you finish your college from, because a lot of the times that's already written on the resume, right? You might put it in terms of an information that is there, but the question of tell me something about yourself is largely your chance to showcase this particular intent in terms of why would you want to do finance, what is it that excites you about finance, and how do you really go about proving that with respect to your interest, intent, projects, experiences, etc., that you would have done in the past. Now, some of us might be thinking at this stage that, I may not have any of these till till the time in the context of this question, because a lot of us might have had a background which was not in finance and now moving towards an MBA in finance, right? So essentially what ends up happening in that kind of a discussion is the first thing we need to understand is we don't need to get defensive about this question, right? If you are an engineer who's doing an MBA and plans to build a career in finance, there's absolutely nothing wrong about that, right? You could be absolutely clear and say that, look, I was not clear when I was doing my MBA, my engineering as to what I was doing. And after my engineering, I realized that probably, I could build a better career being a business guy. And that's why I came to do MBA. And within that context, because of my engineering skills, because of my number crunching skills, I feel finance is something that I can pick up quickly and learn quickly and apply quickly. Finance is essentially an extension of mathematics. So as long as you are good with maths, there is no reason why you can't learn finance. There is absolutely no reason why you wouldn't be able to learn finance, right? So do not ever treat that as a disadvantage. Yes, if you have had a background in finance, that's great. But if you haven't had a background in finance, you don't need to get defensive about it. Don't worry about what's happened. What's happened has anyway happened, right? So when people ask you question about things like your scores in earlier classes may not have been great, or why did you do engineering before getting into an MBA in finance, it's absolutely fine to actually answer it honestly and say that I wasn't clear when I was doing my graduation. And in most of the cases, we might have done our engineering from reasonably decent colleges, done well. Focus on aspects that basically tell you that you can learn quickly and you can apply that quickly. If you can focus on those questions, then that's the first yardstick taken care of, right? These are typically the generic questions you get in the finance interviews. You do get specific questions as well. Let's get to those. Now, the first thing that people will start asking you is the three financial statements. So there are three of those: the balance sheet, the P&L, and the cash flow. And you need to know what are the various uses of these. You need to know how do they link with each other, right? So a very simple yardstick would basically tell you that if you're on March 31st, 2017 and March 31st, 2018, you will typically have the balance sheet as on a particular date. That's balance sheet 1. You will have the balance sheet as on the next date. That's balance sheet 2. In reaching from point A to point B, whatever business transactions a company does fall under the P&L statement, and whatever cash transactions the company does come under cash flows. Each of these statements show something different. The balance sheet shows what do you own and what do you owe to people at any given point of time. It's a stock statement. It's at a given point of time. It's like a snap, right? P&L and cash flows are like videos. They are a flow statement. They are over a period of time. They give you the picture between 2 points of time, and hence they're like videos essentially. P&L tells you whether your business is profitable or not. Cash flow tells you whether you received cash or not, right? It's important to understand these linkages and the uses of these three. Subsequently, you will start getting questions about specific line items within these, right? So you will get line items in these kind of data points. And someone might ask you, what is a contingent liability? What is goodwill? What is minority interest? These are some of the trickier concepts that would start appearing on profit and loss statements or balance sheets or cash flows. You need to be careful about these. You need to know the definitions of these. So contingent liabilities are liabilities that are contingent on an event. For example, if there is a court case that is going on, a legal matter that is going on, the liability may not be defined today. But tomorrow, there could be a scenario where the case goes against you, so the liability could come up. Usually, contingent liabilities would be listed below your balance sheet numbers. It would be an off balance sheet item. Goodwill is basically an intangible asset. It's a sort of value that is attributed only when company A acquires a company B, right? And you have acquired this company B at a premium, right? The way goodwill works is that if, let's say, company A acquires company B on a price point of 2000 crore. So the outflow from A's balance sheet, and let's say it is cash, is 2000 crore, and let's say the assets that come in for company B when you buy it is only 1000 crore. Now, if you paid 2000 crore to get assets worth 1000 crore, the balance sheet is not going to balance, right? So in order to make it balance, what you do is you assume that this extra 1000 would have gone in on account of the brand value of the company. So essentially, that is what is the goodwill portion around it, right? That's attributed as goodwill. Remember, goodwill cannot be calculated generally because the company says that I have a good brand value and hence you should attribute a certain value to me. That doesn't work. You only put goodwill if there is an acquisition, right? Similarly, concepts like minority interest. Minority interest is the equity interest that someone has in a company that is less than 50% stake, right? So if company A holds 80% in company B, the 20% stake that someone else holds in company B is known as minority interest, right? Just read up on some of these line items. That would give you an idea about what kind of questions come. Some of the common questions are these trickier terms that you see in the balance sheet, P&L, and cash flow statements. You might want to kind of revise them as you go along, right? Then you generally get in kind of banking kind of interviews or interviews in investment banking, etc., terms related to banks. Part of it is current affairs, part of it is terms that are there, part of it is regulatory in nature, right? So you could get terms like NPAs, which are non-performing assets, basically loans that banks have given but are not really able to recover those, right? Also known as non-performing loans. Big problem for banks in India at this point of time, where they have loaned out a lot of this money to corporates, and a large chunk of these assets have become non-performing, especially in sectors such as steel, power, and infra. A lot of the companies in these sectors have taken loans in the last 7, 8, 10 years, but not been able to repay those loans, and they have turned NPAs, right? That's a problem. You have to resolve it. You have to resolve it because unless you resolve it, the business cycle does not pick up. Banks will always be careful about lending, too careful or too cautious about lending because they're worried about getting their money back. Companies also will kind of end up getting into a standstill because banks are not lending anything to them. So unless you solve this rut that has been created in between, it is difficult for a big investment cycle to restart in the country where banks start lending freely, right? Banks will always be worried about these non-performing assets. Historically, a healthy cycle would have non-performing assets anywhere between 1 to 3% of your total assets, total loans that you've given out. At this point, Indian banks, a lot of them are operating between 9 to 12% of non-performing assets. So you have to deal with this situation. You have to write off these assets. You have to refinance some of these assets, loans. Only then will things move ahead, right? You could have other terms like things like capital adequacy ratio with regards to banking, right? Capital adequacy ratio. Now, this is basically, let's say the number is 9%. What it means, very simply put, is that how does a bank function? A bank basically takes a deposit, right, from us and it lends that money. Now, it can't just take 100 rupees of deposit and lend 100 rupees of money. That is not possible. It doesn't work. So a bank essentially needs, if it has to lend 100 rupees, it has to take in an equity or own money of 9 rupees at the bare minimum, take 91 rupees of deposits, then it can lend out 100. Very simply stated, that's what we mean by capital adequacy ratio. They need to have adequate share capital of 9% before they are going to lend 100 to someone. So that's the banking capital adequacy ratio that comes in. There are other terms as well, terms such as cash reserve ratio, statutory liquidity ratio, terms around the monetary policy of RBI, where RBI moves the repo rate and all. You should have a sense of some of these. Now, covering each and every of these is probably beyond the scope of this specific video, but you do need to kind of read up a little bit on this if you're preparing on your interview for a finance role, right? You also have terms like price to book value. Now, that's a slightly advanced concept. You are looking at how much value the stock market is giving to the company when you compare it with its net worth, right? What is the net worth? Your net worth is nothing but your total assets, your total assets minus external liabilities, right? So what is left is share capital and reserves and surplus essentially. That's what your book value is, share capital plus reserves and surplus. That basically tells you how much. So if you stop the business today, if you close the business today, you sell all the assets, you repay all the liabilities, what is left is the net worth of the company. Correct? What is left is the net worth of the company. Now, how much value the stock market is giving to this net worth is the market value. The relationship between these two is called the price to book ratio, right? In the general sense, the price to book should not be less than 1. Why? Because technically, if the market is valuing a company at 1000 and the net worth is 1500, then you can sell all the assets, pay all the liabilities, and make 1500 after buying the company for 1000. So logically, there is an arbitrage which is available. You can't have this scenario for a company that is expected to make a profit, right? So that's something that you want to look at. Price to book is a slightly more advanced concept, but you could read about it. NPAs is something that you are probably going to be definitely looked at this particular point of time, because that's something that is a very relevant topic about the Indian banking sector, right? Then you get into essentially topics around financial analysis or businesses. One of the major topics or major common questions that you get is something around working capital. Now, the common definition of working capital is given as current assets minus current liabilities, right? And what is typically taught to us in terms of textbooks is that CA should be greater than CL. We want current liabilities should be lesser than current assets, because that's how you fund your current liabilities, right? Now, if you think about this, and for the purpose of our understanding, also remember that typically you take current assets X cash. So you take non-cash current assets in your discussion, right? Now, think about it. Let's say you're running a business, right? Would you want your customers to pay now or later, right? Most of us would want our customers to pay as soon as possible. So technically, we want zero receivables. We don't want any receivables in our business, right? Given a chance and a choice that your business does not get affected, your demand and supply does not get affected based on your inventory choices, all of us would want to keep zero or low inventory, correct? And given a choice, if someone were to ask you, would you pay your suppliers today or later? You would want to pay this later, thereby keeping it high. Right now, if you're running a business, you want money quickly, you want to pay it later, you don't want any inventory. So logically, your current assets will be very close to zero and your current liabilities will be non-zero high value, which goes exactly against the basic tenet that textbooks teach us, right? So what is the difference? What is important to understand is the second analysis that we did here is from the owner's perspective. So a business owner would want a negative working capital scenario. You don't want a positive working capital scenario. Why? Because you're feeding on someone else's money. Think of Amazon, think of Dell, think of Idea, think of all these companies who basically use someone else's money most of the times, right? If you order something on Amazon, you pay the money first, they buy the stuff using your money and then give you the product. There is no concept of a receivable, there is no concept of an inventory, or there's very little inventory. They can choose to pay later. And by virtue of this, they will have a negative working capital because they're using your money to run their business, essentially, right? On the contrary, textbooks teach us that CA should be greater than CL is because textbooks are being written from the perspective of bankers. There is always a trade-off. You can keep high inventory, you can keep high receivables in order to support your current liabilities, but that is at the cost of lower term, shorter term efficiency. If you're an efficient business, you shouldn't have receivables, you shouldn't have inventory. But if you were a banker, you would want the business to have some sort of current assets so that you could tackle the current liabilities. The trick is to understand what hat you are wearing, and the trick is to understand what is causing this scenario. Are you doing it because you can do it, or are you doing it because this is happening by force? That's an important parameter. Remember, if you are an owner of a business, if you're an analyst who's analyzing a business, you would want negative working capital. That's a desirable state, right? But in real life, that might depend on various businesses, whether they have negative or positive. Some businesses by nature do not have receivables, some businesses by nature do not have inventory, and consequently have a higher chance of showing a negative working capital, right? So that's something about working capital analysis that we need to remember. It's again an important topic. A lot of the people ask this, and we read our textbooks and we come from something called as current ratio, which is CA by CL, and textbooks teach us that this should be greater than 1, and that's where the divergence happens. If it is greater than 1, then we are saying CA should be greater than CL, whereas when you are running a business, you end up deciding that CA should be lesser than CL, right? And that's where the crux of your uh, divergence comes in. It's important to understand that if you're a business owner, negative working capital by choice. When I say choice, you decide when you're running the business if you can have negative working capital. By choice, that's a desirable state, right? So that's something that you need to kind of look at. In terms of discussions around finance, some of the other discussions that typically get asked are things around you know recent news. So for example, at this point there is a buyback that has come around Infosys. It would be useful if you could read about what is a buyback, right? This is a scenario where the company is buying back shares. It's a form of dividend, right? But essentially, it's the exact opposite of an IPO where the company is issuing shares. In this case, you're buying back shares. When you buy back shares, the number of shares outstanding reduce. And so consequently, if there were 100 shares today, after the buyback, 80 will be left. And so next year, your net profit will get divided only in 80 shares. So everyone's share in the company profit goes up. That's why buybacks are treated as positive signals, right? Also, when Infosys comes out and says that I'm going to do a buyback at 1150 when the market price is 900, Infosys is saying that, look, I have cash, which I can basically use in buying my own stock at 1150, and that's because I believe this is undervalued at 1150, right? So it's a signal as well. A buyback is a signaling mechanism as well, where you are saying that, look, I'm doing well and I think this cash is available. I can buy my own share. I don't find other opportunities in the market when I compare it to this particular stock, which is my own stock, and hence I'm buying it, right? That's the buyback. Then there is something called as a bonus issue around Reliance Industries. A lot of companies have given bonus issues. There are others like HPCL, BPCL who have just given bonus issues in the recent past. This is when you get one share. So it depends on what the ratio is, but if the bonus issue is 1:1, then one share for every one share held. You get a new share that is issued to you. The usual outcome of a bonus issue is that obviously the share price becomes half. So what happens in a bonus issue? The share price becomes half, but the dividend kind of becomes increases. It becomes double because companies don't cut dividend per share. So if you have two shares, then basically you get more dividends out of it, right? And typically dividend per share is denoted in terms of something known as face value of the share. Again, something that, the entire discussion on how does a bonus issue work is beyond the scope of this discussion here. But do read about how do bonuses work. Essentially, bonuses signify that the company can pay more dividends. And that's why they are treated as positively. The share price becomes half because the company doesn't change. If you have a company whose value is denoted in 100 shares and I just issue another 100 shares, the value of the company does not change, right? So each share should be worth half now, right? Then in other current news, you could have some macroeconomic news, which is how are oil prices and our currency related, right? You would want to know how much oil do we import, and based on the oil price reduction, what is the saving in import bill? Because of this, what's happening to India's forex reserves? And because of this, what do you expect the currency to do, right? You could look at the numbers from reports that are available on RBI's website or Finance Ministry website. But saving in import bill every year is nearly to the tune of $80 billion. Forex reserves in India have gone up to $400 billion. And that's why the currency is essentially appreciating, because you're getting flows or you are saving $80 billion each year on account of oil prices being lower, right? So technically, if you keep saving it next year, 400 should reach close to 500, right? That would continue. And that's basically how the oil prices and currency are related. If oil prices go up, you would expect the currency to start depreciating, right? There are obviously other forces at play as well in the currency scenario, but you could directly get a question around what is your expectation on crude oil prices in the global markets, and how do you think that affects the Indian rupee when you look at that, right? So that's basically what we are looking at when we are looking at the recent news that you have in terms of your discussion. And then finally, if you get any kind of interview around, let's say, an investment advisory kind of a role, a banking, wealth management, securities kind of a role, you do get these kind of questions: is where should I invest if I have rupees 1 crore or 10 lakhs or so? Typically, people are looking at your idea about how could you create a portfolio, right? So can you do what is called as asset allocation, which is basically, can you divide this money into stock market and bond market and other assets, right? So bond market and other assets like, let's say, gold, etc., etc. Then within this, if you're looking at the stock market, then what sectors do you think will do well? And within the sectors, do you have any idea of the stocks? So what they are looking at is, can you do asset allocation? What they are looking at is, can you select a lot of sectors, which gives you the idea about diversification? And then they are looking at, can you do sector analysis, which gives an idea about industry analysis? Can you analyze what industries are expected to do well? And then as a final stage, if you could reach to stocks, then you could also get tested on a basic understanding of valuation. If you're in the first year, no one really expects you to know in and out about valuation. That's kind of okay, right? People know that you have not read that, so it's fine. Don't worry too much about it. But can you logically think about what do you think are the major areas that will do well in India, right? And you could link it to the currency we just saw. So you could say that maybe pharma will do well, stocks have fallen a lot, and maybe that's a useful sector. You could say banking is reviving because NPA problem is getting solved. You could say some of the segments that are business to consumer in India, like, let's say, retail or FMCG or hospitals or consumer durables or autos, which are basically being driven from the perspective of individuals spending a lot of money. They might do well as the GDP growth continues. And essentially, how does that play out? Right? So those are the typical questions that they are, and those are the typical solutions they are anticipating there. When you create a portfolio, obviously, you are going to look at things around the suitability criteria as well, which is essentially around the portfolio for a 75-year-old guy will differ from the portfolio for a 25-year-old guy, right? So essentially, based on that, you will suggest assets allocations and stock allocation and diversification and what kind of stocks you are picking up. You don't want to pick up very small companies for someone who's a larger, who's someone who is of an older age, right? So essentially, what someone is looking is whether you have a logical framework by which you can allocate the money and invest the money, right? No one really, believes that you know in and out of the stock market or assets or companies at this point of time. But what people do believe is, can you go ahead and think a little bit more about, if someone were to give this money to you, what would you really go about doing with this money, right? So that's about the client advice that we kind of questions that we could get. Let's quickly summarize what we have discussed so far. What we have said is that you could have questions on financial statements. So you should know those questions. You should know what financial statements are, what their purposes are, how do they link with each other. You could get questions on analysis. which is you could get questions on things like ratios, you could get questions on things like working capital, so on and so forth. You could get questions on the banking sector and general economics around the banking sector or the global, market economics around India. You could get questions in terms of current events or news items that are happening in the industry, and you could get questions on portfolio creation, or in general you could get question on the markets. It's important for us, these are all finance domain questions, it's important for us to have some sense on these questions. You will also most likely get questions around why finance, and tell us something about yourself. These are your questions where you try and showcase your ability in terms of why you are someone who would want to be getting into finance. Obviously, your resume also needs to get focused towards that. It's important to look at what your resume showcases about your interest in finance. So there is a separate discussion that you could have in terms of how do you go about looking at your resume. But these are some of the major questions that someone is going to ask you if you were to enter a finance interview. Ensure that you have had some sort of a linkage or reading around these, right? Please understand, this is not an exhaustive list. I will repeat, this is not an exhaustive list. This is just an indicative set of topics that if you are entering into a finance interview, you need to have a good, coherent, clear answer to. You will never be able to prepare 100% for questions, but if you can kind of prepare on these topics, at least you have a fair degree of chance where you can tackle these questions, right? So that's it in this particular segment. Thank you.